Okay, so you ready to dig into this one? We got The Intelligent Investor.
Oh, yeah. A classic.
This isn't just any edition, though.
Yeah.
We're talking the 2003 with all of Jason Zweig's commentary,
Right, right.
which is huge because the book itself, I mean, it was written in '49 originally.
Hmm.
And here we are, 2024, still talking about it.
Hmm.
If that's not proof of staying power in the investing world,
It stood the test of time.
I don't know. What do you think it is about this book that makes it so timeless?
Well, it's interesting you should say that because it's weathered a lot of storms, this book. You think about it, from the inflation in the 70s to the dot-com bubble bursting, it's still like the bedrock,
Yeah.
of value investing. And I think Zweig's commentary just adds a whole other layer to it. He's showing, like, look, even after the dot-com bubble burst, this stuff still holds true.
Right. It makes you wonder what Graham knew that everyone else was missing, you know?
Yeah, yeah, for sure.
So who was this Benjamin Graham? I mean, he wasn't just some, like, armchair economist, right?
Oh, no, no, no. This guy, he lived and breathed Wall Street. I mean, he started out as a clerk, worked his way all the way up. He even ran his own firm.
Wow.
But the thing is, he lived through multiple market crashes.
Like 29, right.
1929, the big one.
Yeah, it is.
Had to be.
Formative.
Yeah, to live through that, to see that, and it really shaped his whole philosophy. There's this incredible story about this company called Savold Tire.
Okay.
So picture this. Booming auto industry. Everyone's piling into the stock. It's the hot new thing. Graham gets in on it, right. He makes a 250% return
250 in a day.
on the first day.
Oh, my gosh. Popping champagne?
Well, hold the champagne, because it turns out it was all a fraud. The stock, it plummets, worthless, overnight.
Oh, ouch. It's got to hurt.
You talk about a learning experience. It's funny because it's exactly this point that Graham makes about speculation versus investing. Savold Tire, that was all speculation. Now, flip side, Northern Pipeline Company. Graham spends like weeks going over these dense reports, really digging deep, and he uncovers this hidden value that nobody else caught.
Wow.
Turns a $65 share into $110, just like that, over a few years.
That's incredible.
That's intelligent investing.
Yeah, okay, I see the difference there for sure. So when Graham talks about the intelligent investor, then, I mean, is he literally talking about someone with a genius-level IQ?
He actually says it's more about temperament than intellect, like
Yeah.
patience, discipline, having control over your emotions, way more important than being, a math whiz.
Right.
The intelligent investor, they think for themselves. They don't get swayed by the crowd.
So they're tuning out all the noise,
Mm-hmm.
which, I mean, especially these days, there's so much financial noise.
All the time. He really dismantles a lot of these common investing myths, like, what's the next big thing? Where's the next? Graham would be like, those are the ones, the obvious growth industries that actually lead to the biggest losses. Or, buying a stock after it splits. He compares it to getting excited about having 2 nickels instead of a dime. It's like you haven't actually gained anything.
Yeah, that's a really good way to put it. Okay, so if I want to be this intelligent investor, what's the playbook look like? Where do I even start?
Well, Graham talks about 2 types of investors. You've got your defensive investor and your enterprising investor.
Okay.
Let's start with the defensive investor. This is someone who they want a solid strategy. Maybe they don't have a ton of time to dedicate to, like deep research. Diversification, that's key for them. Don't put all your eggs in one basket, as they say.
Right. Investing 101.
Exactly. But Graham takes it a step further. He's a big advocate for dollar cost averaging.
Okay.
Take the emotion out of it. Invest consistently over time. He also suggests a pretty hefty allocation to bonds. Now, keep in mind, this is 2003, so bond yields are hovering around
Oh, they were high back then.
7.5%.
Yeah. Those were the days. And index funds, that wasn't quite as big of a thing back then either, right?
You're right. It's interesting, though, because Graham saw the potential in index funds even back then. He liked that they were low cost and, you could just kind of set it and forget it, capture the returns of the entire market.
Yeah.
And, sometimes the best move for the defensive investors, just sit tight, let the market do its thing.
Be patient.
Yeah.
Okay, so what about those more, like, adventurous types, the go-getters? What does Graham say to them?
That's where the enterprising investor comes in.
Okay.
This investor, they're willing to put in the work, dig into the research, maybe be a little more active with their portfolio.
Gotcha.
But even for them, Graham emphasizes this one crucial element.
What's that?
Margin of safety.
Okay, margin of safety. Tell me more.
So it's about never overpaying, no matter how promising a company seems. It's like this built-in buffer for when the market inevitably goes up and down. And he stresses this long-term perspective too, Tune out the noise, focus on those fundamentals.
Yeah, ignore those hot stock tips.
Exactly.
Focus on the bigger picture.
And that's where Graham's analytical tools come in. He talks about low multiplier investing, essentially looking for companies with a low price-to-earnings ratio.
So are they undervalued?
Exactly. Then there's networking capital bargains.
Okay.
This means you're basically buying a company for less than the value of its liquid assets.
So it's like getting their stuff for free.
It's a bargain. And finally, he talks about past performance value. This means looking at a company's track record instead of getting caught up in all the hype about future projections.
Right, because there's a big difference between what they say they're going to do and what they've actually done.
Yeah,
right?
exactly.
It's all about separating those two.
Oh, that's smart.
Okay, so we've talked about the good stuff. What about, like, warning signs? If I'm looking at a company, what are some of those red flags that make an intelligent investor hit the brakes?
Ugh. It's like, how do you spot the trouble before it finds you, right?
Right.
One of Graham's most compelling examples, I think, is the case of Aetna Maintenance Co. This company, they seem to be killing it, posting impressive earnings year after year.
But something wasn't right.
Exactly. There was something off. Graham, he smelled a rat. See, they were using these special charges to basically hide losses.
Well,
So their profits looked way better than they actually were. It was all smoke and mirrors, just designed to trick investors who weren't, digging a little deeper.
so if it seems too good to be true?
It probably is. The intelligent investor, they always scrutinize the fine print. And then, of course, there's the dot-com crash. I mean, talk about a stark reminder of what happens when hype outruns reality.
It unraveled so fast.
Graham saw it coming a mile away. He was cautioning against these speculative bubbles.
And so many people, they thought they were, like, can't miss opportunities.
Mhm.
And then it was like, oh, can't believe I fell for that.
Yeah, it all goes back to fundamentals, No matter how shiny the surface might look, you got to look at that underlying value.
Yeah.
Graham, he called out those, what he called OPM addicts companies, hooked on borrowing and diluting their stock just to keep up appearances. And don't even get them started on serial acquirers. These are the companies that grow by gobbling up other companies, but they're not actually building anything themselves.
Right, right.
And remember, Enron, WorldCom, these scandals, they were wake-up calls. You got to pay attention to conflicts of interest, corporate governance. Those things matter.
Absolutely. It's a lot to keep in mind. I remember, like, when I first started investing, I felt so overwhelmed. But one thing that really helped me was Graham's analogy of Mr. Market.
Ah, yes, Mr. Market.
Yeah.
Classic Graham. And it's such a powerful concept. So imagine you've got this business partner, right? His name is Mr. Market, and he is incredibly emotional.
Oh, no.
Some days he's euphoric, he's willing to pay top dollar for your shares. Other days he's like completely despondent. He's begging you to sell low.
Sounds exhausting.
It can be. But here's the thing. Mr. Market's mood swings, they don't always reflect the true value of the business.
Okay.
The intelligent investor, they learn to recognize those swings for what they are. Emotional overreactions.
Oh, so you can actually use those mood swings to your advantage.
That's the idea. When he's overly optimistic, maybe it's time to sell. When he's panicking, maybe that's your buying opportunity. But of course, you got to make sure the underlying business is sound. It's about playing that long game. Don't get swept up in the day-to-day drama of the market.
Right, right. Speaking of playing the long game, Graham, he was a big proponent of index funds, wasn't he?
He was ahead of his time in a lot of ways. Back in '03, index funds, they weren't as popular as they are now. But Graham, he saw them for what they are.
What's that?
A simple, low-cost way to just capture the returns of the entire market. He especially liked them for the defensive investor, someone who doesn't have the time or the desire to be, picking individual stocks.
Right. It's like that old saying, don't try to beat the market, be the market.
Exactly. Now, on the flip side, for those who are interested in exploring specific companies, really getting into the nitty-gritty evaluation, Graham actually provides some fascinating case studies in the book. One that really stood out to me was his analysis of closed-end funds.
Closed-end funds. Those always seemed a little mysterious to me.
Yeah, they can be. But they also offer these intriguing opportunities. See, unlike an open-end fund, like your typical mutual fund, which issues and redeems shares continuously, A closed-end fund has a fixed number of shares.
Okay.
And those shares, they trade on stock exchanges, just like a regular stock.
Gotcha.
This means that they can trade at a discount or a premium to their net asset value, their NAV.
So it's like you're buying a basket of stocks, but instead of paying the exact value of those stocks, you might be able to get them at a discount.
That's the idea. Graham, he found that closed-end funds, they often trade at discounts, especially during times of market uncertainty. This creates opportunities for savvy investors who are willing to do their homework.
Interesting. So where do open-end funds fall into this?
Open-end funds, they're always priced at their NAV, which makes sense, but you don't get that same potential for finding, hidden value through discounts.
Right. So it's like finding a hidden treasure chest. With closed-end funds, you have to know where to look, and you have to be patient.
You got it. Graham, he was a master of uncovering those hidden gems, and he provides several other examples in the book. Like he talks about low multiplier investing, seeking out companies with low price-to-earnings ratios.
So like buying a dollar for 50 cents, essentially.
Exactly. He also highlights the importance of networking capital bargains. You're essentially buying a company for less than the value of its liquid assets. Imagine buying a car for less than its scrap metal value. That's a networking capital bargain.
Wow, that's a steal.
Talk about a deal. It's no wonder they call him the father of value investing.
He really earned that title.
He did. But it's not just about the numbers for Graham. He also emphasizes the importance of understanding a company's management team and their corporate governance.
Makes sense?
Because even the most undervalued company in the world, it can't perform if it's run by a bunch of,
Bad guys.
crooks, or if they have terrible corporate governance practices. So yeah, you got to check under the hood, even if the price seems right.
Right, you got to find a trustworthy mechanic, basically. You don't want them to steer you wrong.
Exactly. Now, speaking of steering clear of trouble, Graham dedicates a good chunk of the book to warning signs, potential pitfalls. And one that I think really resonates is this concept of past performance value.
Past performance value. Is that different than just looking at their track record?
It's more than that. A lot of investors, they get caught up in projections, promises about future growth. Graham's urging us to look beyond the hype, to analyze a company's long-term track record of actually generating value for shareholders.
Okay, so what have they actually done? Not just what they say they're going to do.
Exactly. He suggests analyzing things like earnings growth, dividend payments, book value, but over a significant period of time. He talks about 10 years.
Wow.
It's about separating the companies that consistently deliver from those that are all talk and no action.
So like the seasoned athlete versus the rookie who has all the potential but hasn't actually proven anything yet. Give me the athlete who's been there, done that, knows how to win.
Perfect analogy. And, another area where Graham really shines is his emphasis on shareholder rights and activism.
Okay.
He believed very strongly that investors, they shouldn't just be these passive bystanders.
Yeah.
They should hold management accountable. They should advocate for their interests.
So don't be afraid to, speak up if you think something's fishy.
Exactly. Graham actually encourages shareholders to carefully review proxy statements, attend annual meetings, even consider challenging management when it's necessary. It's like, remember, you're not just buying pieces of paper here, you're becoming a part owner of this business.
Oh, that's a powerful way to think about it.
It is. It's about taking ownership of your investments, not just handing over your money and hoping for the best.
Right, right. And, one of the things I really appreciate about Graham is he doesn't shy away from the mental game of investing. You know what I mean? He talks a lot about temperament.
He does. He constantly reminds us that our biggest enemy, as investors,
Oh.
ourselves.
Oh, interesting. How so?
It's so easy to get caught up in the emotions of the market, right?
Oh, yeah.
Fear, greed, they cloud our judgment. We buy high because of FOMO. We sell low in a panic. And then later we're like, why did I do that?
Ugh, the worst. I've been there.
It's amazing how our emotions can just sabotage our best intentions.
Absolutely.
That's why Graham, he stresses the importance of developing a sound investment philosophy, one that's grounded in logic and reason and a long-term perspective.
Right.
He wants to remind us that the market, it's not a casino. It's a mechanism for owning a piece of great businesses.
It's about tuning out the noise and focusing on the fundamentals.
Exactly. And that brings us back to one of Graham's most fundamental concepts, and I think this is so key, margin of safety. He believed this was the cornerstone of intelligent investing.
Margin of safety. Remind me what that is again?
Yeah, so essentially it means buying assets for significantly less than you believe they're actually worth. Think of it like building in a buffer zone around your investments. Like if you're buying a house, you want to make sure you're not paying more than it's actually worth, right?
Right.
Same principle applies to stocks or any other asset.
Okay, that makes sense.
So you're building in that cushion, protecting yourself from uncertainty, market fluctuations, all of that.
Gotcha.
And Graham, he actually suggested aiming for a margin of safety of at least 50%. So buying assets for half of what you believe they're truly worth. Now, I know that might sound like a tall order, especially in today's market.
Yeah.
But he argued that by focusing on undervalued assets and being patient, you can find those opportunities.
Don't be afraid to wait for the right pitch.
There you go. Be like that disciplined batter at the plate waiting for the perfect swing.
I like that.
Yeah.
Okay, so let's talk real-world examples here. Graham, he provides a bunch of case studies in the book to kind of illustrate these principles in action. One that I found really interesting was his analysis of Penn Central.
Penn Central, what a story.
What happened there?
So this was a once mighty railroad company that shocked the financial world by going bankrupt in 1970.
Bankrupt. Wow.
A big deal.
A pretty dramatic example.
And it was a major event, and Graham actually uses it to illustrate the importance of looking beyond a company's reputation, like really digging into the financials. See, Penn Central, they'd been this blue chip stock, a symbol of American industry. But behind the facade, there were warning signs that investors either missed or chose to ignore.
What kind of warning signs?
Well, for one, their debt levels, they were rising rapidly. They were making a lot of acquisitions, but they were overpaying for them, which put even more strain on their balance sheet. And to make matters worse, the earnings were becoming more and more volatile.
So it's a classic case of a company trying to grow too quickly, taking on too much risk.
Exactly. And it's just a reminder that even the most established companies, they can stumble, they can fall if they don't manage their finances prudently.
That's a sobering thought. It makes you realize, like, no investment is truly risk-free.
Absolutely. That's why diversification is so important. But it's also why Graham, he stresses the importance of doing your own due diligence. Don't just rely on a company's reputation or past performance.
Right. Don't be afraid to, like, ask the tough questions and walk away if something doesn't feel right.
Exactly. Now, let's shift gears a little bit, talk about another fascinating case study. Ling Temco Vought, LTV for short.
LTV. That rings a bell. What was their story?
So LTV, they were a classic example of a conglomerate in the 1960s, growing rapidly through a series of acquisitions. But here's the catch.
Oh.
A lot of those acquisitions, they were financed with debt.
So they're building a house of cards.
Basically. And just like a house of cards, LTV eventually collapsed under the weight of its own debt when the economy took a downturn in the early 1970s.
Oof. Another cautionary tale about over-leveraging. It seems like that's a recurring theme, you know?
It really is. And it just highlights the importance of carefully analyzing a company's balance sheet,
Right.
really understanding their capital structure.
So don't just focus on the earnings. Look at the debt, too.
Exactly. Now, let's dive into a slightly more complex case. NVF Corporation. This one involves some accounting, shall we say, maneuvers that I think are worth understanding.
Accounting maneuvers. Ooh, sounds juicy.
It is kind of interesting. So essentially, NVF, they used a series of transactions involving shares of Sharon Steel to basically inflate their earnings.
Ooh, sneaky, sneaky.
They made it look like they were making way more money than they actually were.
So again, playing games with the numbers.
Exactly. And Graham uses this case to illustrate how important it is to be critical of financial statements, to really understand how companies can manipulate accounting rules to their advantage.
Right. It's like they say numbers don't lie, but liars can figure.
That is a good one. Always remember, accounting, it's an art as much as it is a science. Now for our final case study, let's look at Kaiser Frazer. This was a once promising automaker that experienced like this really dramatic rise and fall in the post-war years.
Caesar Fraser. I'm not familiar with him.
Yeah, they were a big deal for a while there. See, after World War II, there was this huge surge in demand for cars. Kaiser Frazer, they capitalized on that, and they initially thrived. But their success was short-lived.
What happened?
Well, for one, they failed to adapt to changing consumer tastes. As the market matured, people, they wanted more than just basic transportation. They wanted style, they wanted comfort, they wanted features.
And Kaiser Fraser just couldn't keep up.
Exactly. They also faced really intense competition from larger, more established automakers, GM, Ford.
Right.
And on top of that, they made some, shall we say, questionable management decisions, like overexpanding their production capacity, investing in unprofitable ventures.
Oh, no.
Yeah, it was a combination of external pressures and internal missteps that ultimately led to their downfall.
Wow, what a story.
Right.
It just goes to show, even in a booming industry, success is not guaranteed.
Right. You need constant adaptation, innovation, and, of course, sound management.
Yeah, it's a jungle out there. So we've covered a lot of ground here. Graham's core principles, these cautionary tales, real-world examples. For listeners who are just starting out on their investing journey, what's the key takeaway?
That's a great question. I think the most important thing is to approach investing with this mindset of continuous learning.
Okay.
Don't be afraid to ask questions, do your research, seek out mentors or resources that resonate with you. And remember, investing is not about getting rich quick.
It's a marathon, not a sprint.
Exactly. It's about making informed decisions, managing your risk, and being patient. And above all, it's about tuning out that noise and focusing on the fundamentals. Now, are you ready to explore some more of Graham's fascinating insights? Because there's so much more to uncover.
I'm ready to dive back in.
Mm.
Let's talk about Chapter 18, where Graham compares these 8 pairs of companies. I've always found that chapter to be incredibly insightful.
Okay.
Chapter 18, this is where Graham, he gets into those, like, company face-offs, right?
Yeah.
Battle of the balance sheets.
Yeah.
He takes these pairs of companies that, on the surface, they might seem pretty similar.
Yeah.
Maybe they're in the same industry, maybe they've got similar products.
But then he really dissects their financials, their management styles, their whole approach to business. It's like a masterclass in security analysis.
So he's showing us how to tell the difference between, like, a solid investment and maybe a potential trap.
Exactly. And he really wants you to understand those nuances. Take, for example, Real Estate Investment Trust and Realty Equities Corporation.
Right.
Both of them operating in the real estate sector. But their approaches, night and day.
Really?
Yeah.
What were the big differences?
So Real Estate Investment Trust REIT, for short, they were incredibly conservative,
Okay.
kept their debt low, focused on generating steady income from their properties. Now, Realty Equities, on the other hand,
Yeah.
all about that rapid growth. Acquisitions, often financed with borrowed money.
Oh, okay. So it's like the tortoise and the hare of real estate investing.
I like that. And who do you think won the race in the end?
I'm going to guess slow and steady won this one.
You got it. Real Estate Investment Trust, their conservative approach.
Mm.
Way more resilient, way more profitable over the long haul. Interesting.
And I think it's a perfect example of why you have to understand a company's financial strategy.
Yeah.
How much risk are they willing to take on?
It's not just about how much money they're making, it's about how they're making it.
Exactly.
Mm.
Okay, let's move on. Another pairing, Ultra Corporation and Emerson Electric Company.
Okay.
Ultra, classic conglomerate, involved in a bunch of different businesses.
Yeah.
Emerson,
Yeah.
laser focused,
Yeah.
electrical and electronic products. That's it.
So diversification versus specialization.
You got it.
Yeah.
And in this case, Emerson's focus, that specialization, winning strategy.
How so?
By sticking to their niche, they developed this really deep expertise, built strong relationships with their customers,
Okay.
and ultimately they generated better profits, better growth.
So it's like that old saying, jack of all trades, master of none.
Mm-hmm.
Sometimes it's better to be really good at one thing than just okay at a bunch of things.
Exactly. Okay, last comparison.
Yeah.
Let's talk about Emery Air Freight and Expeditors International.
Both in the air freight industry, Emery was the big dog, established player, long history in the game. Expeditors,
Yeah.
new kid on the block.
Yeah.
Smaller, more agile, and they were hungry.
Okay. Sounds like we've got a classic David versus Goliath situation here.
And that's kind of how it played out. See, Expeditors, they had this really entrepreneurial culture, customer service. That was their jam. And they were not afraid to take risks.
Gotcha.
Emery. They got bogged down in bureaucracy, struggled to keep up with the changing market.
So Expeditors, they were able to win over customers, gain market share.
Exactly. I think it's a great reminder that size and age, they aren't always advantages in the business world. Sometimes those scrappy upstarts, the ones with something to prove, they come out on top.
I love that. It's a story about innovation and agility winning out over, like, complacency.
It is. Now, as we go deeper into The Intelligent Investor, I think it's important to remember that Graham wasn't just about analyzing companies and spotting bargains.
Right.
He was also really big on the psychological aspect of investing.
The psychological aspect. What do you mean by that?
Well, he recognized that our emotions, They can be our worst enemy when it comes to making investment
Oh,
decisions.
yeah.
Fear, greed, they cloud our judgment. They lead us to make these irrational decisions that totally sabotage our long-term goals.
I've been there. You get caught up in the excitement or you think you're going to miss out, so you start buying and selling and buying and selling.
Exactly. And that's exactly where Graham's concept of Mr. Market comes in. Remember our friend, Mr. Market, that emotional business partner we talked about earlier?
Right, right, right. The one with like the market mood swings.
Exactly. And Graham's point is, don't let Mr. Market's emotions dictate your decisions. You gotta use those mood swings to your advantage.
Oh, interesting. So like when everyone's panicking, that's actually when you should be looking for opportunities.
You got it. When Mr. Market is overly pessimistic, when he's offering to sell you valuable assets at a discount, that's when the intelligent investor starts looking for bargains. And on the flip side, when he's overly optimistic, when he's willing to pay top dollar for anything and everything, maybe time to take some profits off the table.
So it's almost like you have to be contrarian,
Mm.
like go against the herd.
In a way, yeah. But it's not just about being different for the sake of being different.
Right.
It's about being rational, being unemotional, making decisions based on a solid understanding of what something is actually worth.
So you're like the eye of the storm. Everyone else is freaking out, but you're calm, you're collected.
That's the essence of the intelligent investor mindset. Okay, are you ready for one final nugget of wisdom from Benjamin Graham?
Hit me with it.
He says, and I quote, "The investor's chief problem and even his worst enemy is likely to be himself."
Ooh, that's deep. So we are our own worst enemies when it comes to investing.
It's so easy to let our emotions get in the driver's seat.
Right.
But by understanding those biases, by really cultivating patience and discipline, by focusing on the long game, that's how we overcome those obstacles. That's how we achieve our financial goals.
So it's a journey of self-discovery as much as it is about like understanding the markets.
I love that. Beautifully said. And that, I think, is what makes The Intelligent Investor such a timeless and essential read. It's not just a how-to manual. It's a guide to navigating not just the market, but ourselves.
That is so true.
Yeah.
This has been an amazing deep dive. I feel like I have a much better grasp on Graham's principles and like how I can actually apply them to my own investment journey.
It's been such a pleasure sharing these insights with you. And remember, the journey of an intelligent investor, it never really ends. It's all about continuous learning and growth.
Well said. And on that note, I just want to thank you so much for joining me on this deep dive into the intelligent investor.
It's been a pleasure.
And to our listeners, thank you for taking this journey with us. We hope this deep dive has empowered you to become more confident, more successful investors.
Happy investing, everybody.